Welcome to the Remarkable Retail Podcast, Season 5, Episode 17. I'm Michael LeBlanc.
And I'm Steve Dennis.
And we're presented by Marketdoff. Forgot that one. You know why I forgot? I'm on the road. I'm on a different kit. I sound different. You sound different. Where are you, Steve?
I am at the fabulous JW Marriott Grande Lakes, which I will say the hotel is lovely, but the marketing's a little bit of a misnomer. The lakes are quite pequeño, muy pequeño, but still very nice.
Nice Texas speak.
Yeah.
Nice Texas.
Thanks.
Speak.
And I was yesterday. I did a keynote for the ICSC, their law conference. So it's the first time I've spoken to a bunch of lawyers, about 1,000 of them. And
good audience.
It went really well. It was a little bit of an interesting audience because essentially my message was you need to tell your clients to take more risk. And that's not generally a thing that the legal community loves to hear. Where are you?
I am in rainy Vancouver, right beside a very large body of water, overlooking the Pacific here in Vancouver. I just wrapped up emceeing the Retail Council of Canada's Retail West conference, which was we had a fantastic roster of speakers, and Christine Day, who's been a guest on our show, and I wrapped it up with some chitting and chatting, and she says hello. So Christine, of course, from the House of LR&C, and we were chitting and chatting on the stage about all kinds of different things. So yeah, it's a great event. So that's why we sound a little bit different. We have a great episode coming up. We have an exclusive interview with Hal Lawton from Tractor Supply, and you knew and met Hal. And he was kind enough to join us on the mic. What a fantastic story and what amazing lessons that we'll be able to share with our listeners.
Yeah, I got connected to Tractor Supply about 4 years ago when Greg Sanford was the CEO. I worked with Greg at Sears, and I did a little presentation for their executive team and subsequently talk about Tractor Supply quite a lot in my book. And then, I reached out to Hal, who I did not know, to see if he might come on the podcast. And miraculously, really, he said yes. But he also invited me out to Nashville to speak at an event of his. And so, I've been spending a fair amount of time in Tractor Supply world during the last few months. So, great. He's a really amazing guy, and the Tractor Supply story is a super interesting one. So I'm sure our audience will enjoy it and learn a lot.
Yeah, fantastic. Even if you don't know that much about the brand, you probably heard of it, but you'll learn lots about it and great lessons and great insights. So we'll get to that right after the news. It's been a super busy week. Where should we start? Let's start on the economic situation. We always, not an economics podcast, but it's so relevant to our audience. What say you of the economic tea leaves?
A huge week. I mean, surprisingly, at least to me, the U.S. economy had positive GDP growth, and most folks, as this recession narrative has been taking hold, this was a bit of a surprise, but you have to kind of unpack the component pieces of it, and a fair amount of that was driven by services and by government spending and some other categories. We definitely saw slower consumer spending growth and a huge decrease in housing-related investments. And then we kind of put that with some of the other information we get around, for example, mortgage rates in the U.S. are now above 7%. That's the highest in 20 years. One of the things I saw in one of the stories I read was just somebody quantifying, what does that mean in terms of kind of the effect on disposable income? And if you've got a $300,000 mortgage, that means you're paying $710 more a month than you would have had you gotten a mortgage back in January. So if you think about new homeowners or maybe somebody with a variable interest rate, that's a lot of money. Not too surprisingly, with the mortgage rates going up, we saw both new home sales tumble, as well as I just saw right before we got on air here that pending sales for all homes, so that would be existing and new homes, had a huge decline as well. So just a lot going on. The other thing I was going to mention briefly under the category of ship not happening.
I see what you did there.
I just love puns.
Yeah.
The Port of Los Angeles handled the fewest amount of import containers in the month of September. That's the most recent data since the Great Recession.
Let's see. Earnings seasons, I guess, has started, right? I'm not sure we have. Well, we have one to talk about. That's Amazon, right? They talked about their earnings and, what.
It was a big earnings week for a lot of the tech firms. So we're not really quite into the heart of retail earnings. That'll come in a few weeks. Amazon is on a calendar schedule, not the January year ending. So they report a little bit earlier. But it was a pretty rough week for tech stocks. But Amazon reported, and on the positive side, they did return to overall profitability, and they did return to double-digit sales growth. But for the most part, I would say their earnings announcement was a bit of a train wreck, and the stock is down pretty big. We're recording this on Friday, and when I looked a little bit a few minutes ago, the stock was down about 12%. Actually, the stock is down 50% from its high. So that's pretty significant. But a few just quick things to mention without going into too much detail. AWS, which of course is the big profit driver historically there at Amazon, had a pretty good quarter, but the growth is slowing down. And there's a lot of speculation on what's going on there, whether that's really kind of macroeconomics or just, it's a big business. Sales are not going to grow at 30 to 35% forever. So I'm not sure what to make about that. But the retail segment really continues to be kind of a mess. The profits, sales were up actually pretty decently. North American segment was up about 20%, but the operating income was negative and was a pretty big swing from a year ago. When you look at Amazon, they've got three big operating segments that they report. They break out AWS, they break out North America, and they break out international. Now, North America and international include retail, and retail is physical stores, it's their own first-party sales, and it's their third-party sales. But it's also advertising, and it's also subscription services. And so it's hard to completely know what's driving what because they don't give a level of granularity around profitability. But what I would say overall is if you look at North America and you look at international, both of which are losing quite a bit of money and seeing their operating losses widen, I think it's reasonable to assume the advertising business, which is large and continues to grow, is highly, highly profitable. So if you look at everything else, that suggests not very profitable. Now, there is this argument, which I know we've gotten into a little bit, that you really can't separate advertising from retail. That's sort of the combined business model. But I think there is some evidence. Yeah. But, you really can't have retail as a loss leader if, your overall business combined doesn't make money. Like that still doesn't seem to be a good combination. But anyway, it's hard to tell how much of this is really huge cost structure issues we've talked about, and they've talked about how they've still got too much capacity and distribution, and they're starting to make some efforts to get their costs down. They got hiring freezes and things like that. But you'd still think, even with some of those challenges with the sales growth they've experienced and how mature this business is, that you would see more profitability, particularly since advertising has got to be amazingly profitable. So not a great picture. And I guess the last thing I'd say about it is they pretty much signaled trouble ahead. They expect that their holiday season is going to be the worst they've had in a long time, and just generally said a bunch of things. If you listen to the analyst call, as I did, that they're pretty worried about the immediate future, and basically said they're not sure how it's going to turn out, which doesn't inspire a ton of confidence.
Yeah, no kidding. And the AWS information is interesting. It's one of the first dips I've seen in their reporting or confidence. Now that could be, they got some pretty big competitors going after that business, or maybe AWS becomes a little bit of a bellwether of the economy. Like you look for key indicators. Maybe Amazon sales slipping indicates retail. Maybe AWS indicates a broader thing. So it's they are a size of which it does become, basically a key indicator to other things. Not directly a retailer, but kind of sort of yes. Meta, they had an earnings, how shall we say, train wreck. The metaverse cash is flowing. What's going on? Well, I guess I know what's going on. They're making a big business bet. If we step back and understand what's happening, they're making a massive bet that the metaverse, their Oculus, their devices will be the change to their business that that takes it to the next level. That's how I would assess what they're trying to accomplish. Yeah, would you agree?
Yes, I agree. But I think before we do that, we should have a moment of silence for Mark Zuckerberg, who sadly lost $32 billion in market value this week in his own personal stake. And that is such a sad story that I do think we should show a little bit of respect for that. Wow. They have spent, I think it's $15 billion so far on building out the metaverse, and they are going forward undaunted. And a lot of strong statements about how much money they're going to plow into that. And let's say Wall Street was not too happy with that. The other thing that's going on, which I think also speaks to what Google reported, is that digital advertising spending is definitely, I guess you could say, nicely moderating if you're affected by the changes, the privacy cookie changes from Apple. So that was also another thing that was not a very good story. So there is this big bet on the future of the metaverse, which I don't think any of us think is likely to pay out anytime soon, and then just kind of the headwinds around the shift in users to places like TikTok, but also just the shift in digital advertising away from the guys like Facebook and Google.
Well, certainly when we're at the conferences we attended, particularly thinking back to Grocery Shop, the retail media network's big selling point is encouraging the brands to pull money away from the platforms and move them to retailers. So I'm not sure how much of that is happening, but it certainly is not a helpful trend. Again, Meta.
Yeah, I think outside of Amazon, it's still relatively small, but it's absolutely growing at an accelerating rate. So yeah, that's not a favorable trend either.
What make you of all this these changes at Twitter, and any thoughts on that would be relevant to our audience?
Twitter's not. This is one of the issues, right? That Elon, now AKA the chief twit, is now.
You see that sync thing? Do you see that sync video? Let this sink in.
Yes,
oh my God! Bad joke of the week.
Yeah, he everything with the kitchen sink, I guess, but he included the kitchen. I don't know. Yeah, I mean, I'm going to
sink in. I think. I don't know.
Yeah, I think. Nobody probably wants us to do a whole episode on Elon, but in any event, yes, he has the deal closed. He paid what I think will turn out to be a stupid amount of money, unless he can actually come up with a revenue model that works. And it seems like there, all roads lead to either subscriptions or increased advertising, or likely both. It will be relevant to more retailers if, in fact, Twitter can start to put together a more compelling picture for advertising. But they're not insignificant, but they're nowhere in the game like so many other players are. So another watch this space kind of thing. The other thing I'll mention quickly is Elon also tweeted this morning or last night, the bird is freed, which then caused Mark Benioff, the CEO of Salesforce, to tweet a picture of fried chicken saying the bird is fried. And I don't know if he was just trying to be funny or that was a comment on the future of Twitter, but we'll let our audience decide.
These multi-billionaires, they have their own ways. I would say, stepping back, that one of the things they probably need to do that they've already articulated is get to where we hear, like when we spoke to our friends at Alibaba, this super app idea to free up commerce within, the way that we see it in China. And if, nobody's been able to accomplish that yet, maybe Twitter has a shot. It's a long road ahead, but that's one kind of good connection, I suppose, back to the retail community. Now, back to retail, Bed Bath & Beyond CEO is now permanent.
Yeah, Sue Gov, who has been acting as the interim CEO, has gotten the job, quote unquote, permanently. I'm not sure anybody is a permanent CEO at any retailer these days. And I guess all I have to say about it is thoughts and prayers.
Just before we get to our great interview with Hal Lawton from Tractor Supply, let's hear from our friends at Market Dial. Hey, this is Michael. Are you heading to the NRF Big Show in New York in January? Steve and I will be there. In addition to chitting and chatting with our top retail leaders in the industry in the Market Dial booth podcasting studio, we'll be on stage with Gretchen Gans, SVP of Strategy and Analytics from the remarkable Container Store. See us live in person Monday, January 16th, 12:30 p.m., Expo Level 3, Expo Stage 3, for Shift Happens. Choose Remarkable or Irrelevance. Brought to you by Market Dial.
Well, Michael and I are delighted to welcome Hal Lawton to the show. Hal, how are you today?
Doing great, thanks. Appreciate you having me on. Look forward to the discussion.
Well, you and I actually have you and I talked about this. I have sort of a long history with Tractor Supply, in some respects going way back to my Sears days, where I first heard about Tractor Supply, and I was trying to figure out just what the heck is this company. And then here we are all these years later, where you guys have just become this behemoth, or we're on this incredible roll. And I got to learn a bit more about what you guys were up to when I was visiting with you a couple of months ago. So thanks for inviting me to come out to Nashville. But why don't we just get started off with a little bit of background? Maybe you could just tell our listeners a bit about your personal and professional journey, and then we'll jump into the growth story that is Tractor Supply Company.
Yeah. And again, thanks for having me on. And I was born and raised in Kingsport, Tennessee, and that's the northeast corner of the state. And I was a math and science kid growing up, and my dad worked for Eastman Chemical, which is and the company's kind of historically been run by chemical engineers. And my dad was in finance, but in his world, his paradigm was that chemical engineers ran the world. And so since I was decent at math and science, kind of one thing led to another. I went to North Carolina State University and got a degree in chemical engineering. And then I worked as an engineer at a paper mill for a few years after undergrad. Steel-toed shoes, hard hat, safety glasses. Great first job to really, and kind of set me on a path of in a journey around the notion of stewardship and servant leadership, and just really understanding the need to empower kind of the front lines of a business and such. After a few years of working at a paper mill, I went back to business school at the University of Virginia, and right around that same time married my wife, Jody. We've been now married for 24 years. And then after business school, worked for McKinsey for 5 years in their Atlanta, Georgia office. And then after 5 years at McKinsey, went to work at Home Depot and spent 10 years at Home Depot. So that 15-year period was all in Atlanta. And that's where we had our three children were all born there as well. And, while I was at Home Depot, that's really where I kind of fell in love with retail, kind of all the things that come along with retail in terms of proximity to the customer, the speed at which you can see changes, the thrill of seeing, hourly and daily sales results. Over time, found this passion for kind of hard lines retail at Home Depot, and had a fantastic career there. I started in strategy and business development, typical consultant entry path, then into finance. Then I ran online for a handful of years before eventually moving into hard lines merchandising and finishing my career at Home Depot there. And then in 2015, after 15 years in Atlanta, we packed things up and moved out to the West Coast. And I ran North America for eBay for 3 years, in addition to a few global functions. And we lived in the Silicon Valley kind of Bay Area there. And it was for me, a fantastic period of growth and development to kind of live in the epicenter of global technology and to see e-commerce at such large scale. After 3 years of being at eBay, or nearly 3 years, moved to New York City, where I served as the president of Macy's, and did that for nearly 3 years before joining Tractor Supply in January of 2020, and really coming full circle back to the state of Tennessee, because Tractor Supply is headquartered in Brentwood, Tennessee, just outside of Nashville, and humbled by the journey that I've been able to be on, and a lot of luck and fortune, but a lot of great companies along the way, and it's really been, the journey's been able to provide some pretty credible experiences for my family and myself.
Wow, what a great career journey. We've talked to several folks who moved on from McKinsey into retail, and it's so interesting, the training you get there, and then you're, as you said, full circle right back into the the hard lines business. I love the hard lines business. I spent a bunch of years at Black & Decker, so I'm more than familiar with Tractor Supply. And for a lot of the listeners, they may or may not be familiar with Tractor Supply. So, or if they're familiar, they may not know full scope and scale. So tell us a little bit about the scale of the organization and the profile of your customers, both on the consumer and pro side. Maybe they overlap, and give us a bit of 411 on the business.
Start with the company was founded in 1938. So we're coming up on our 85th anniversary. Numerical description of the company. We'll finish this year at around 2,150 stores, 2,150 in 49 states. The only state that we don't have stores currently is in Alaska. We'll exceed $14 billion in annual sales this year. So the average store does $7-ish million. And we have over 50,000 team members. So the average store has 15 to 20 team members in it. We've got what will soon be 9 distribution centers for a total of about 10 million square feet. And there's another 5,000 or 6,000 team members in our distribution centers. And so that's a bit of a numerical description. Mm-hmm. If I were to step back, we're a lifestyle retailer, and we serve life out here. And those words are very purposeful in their use. When we talk to our customers and ask them to describe where they live, what their hobbies are, the type of things they do for fun or what they do for work, invariably the words out here are almost always used. And what that really means in terms of life out here, these are homeowners, landowners, pet and animal owners, but they live typically in exurban or rural environments, typically live on anywhere from 2 to 10 acres of land. A lot of times they'll be described as kind of hobby farmers, but it can manifest itself in many ways. And our store is a reflection of that lifestyle. We are not a category retailer. We are a lifestyle retailer. So by contrast, if you think about like a Bed Bath & Beyond or a Best Buy, right, they're very much a category retailer. We have everything from apparel to pet food, to animal feed, to agriculture equipment, to power tools and truck boxes and trailers, to riding lawnmowers and live goods and fruits and vegetables. So and really we are, our intention is to be a one-stop shop for the out here lifestyle. And we do that, as I said, in a little over 2,150 stores by the end of this year, with each store being around 18,000 square feet in size. So a bit like the size of maybe a Walgreens.
Right on. And what about e-commerce? So you got a big background in e-commerce. Is that a significant part of the business for the folks out there?
Yes, it is. We do nearly right around $1 billion on our website a year. We go to market through the whole array of channels from our obviously our website, and it manifests itself in a mobile site as well as our mobile application. And about 75% of our $1 billion online is picked up in a store, with 2/3 of that picked in store and picked up, but the other 10-15 points shipped to a store to be picked up, and then the remaining 25% is shipped to a customer's home. But it's a very attractive channel for us, and very integrated into our overall model.
You've had incredible growth and success over the past number of years. You probably got a bit of a bump from the COVID era. I know formats similar to yours here in Canada were allowed to stay open when others were closed because of their role in feeding people. As you said, the hobby farmer or farmer, you had an important role in that. But stepping outside of that, what are the key differentiators that make the business successful? You described location, assortment, merchandising, your segmentation. If you had to put your thumb on the kind of couple of key things that really have been the key drivers of growth for you and success, what would you say?
Yeah, to your point, we've had a lot of success over the past few years, really kind of in a post-COVID world. Our sales are up in the third quarter. We just completed our third quarter and reported earnings results. and our sales on a 3-year basis are up 65%. We've been the benefactor of a number of secular trends that have remained structurally sound in the post-COVID world. And examples of those would be kind of this notion of rural revitalization, where you've got people that have moved from urban and suburban environments either out to ex-urban or rural environments. The notion of pet ownership and pet adoption, we had a significant uptick in that over the last few years. Other trends like homesteading, and then just really this self-reliance mentality. In many ways, we are the grocery store for our customers' animals, and it's a demand-driven, needs-based business. And there's just been an elevated and sustained elevated demand in a post-COVID world for our type of lifestyle and categories that we serve. What I would also say, though, while that's been these secular trends have been a big driver of our sales growth, they represent really maybe about half of our sales growth. So call it 30 or 40 points of our sales growth. The remainder, kind of 25 to 30 points, is really around share gain. And it's an area that we've been very focused on serving our customers in this really dynamic, ever-changing environment that we're living in right now, and making sure that we live up to their needs. And that's very simply being in stock. So we've been very focused on making sure we have enough inventory to satisfy our customers' needs, having the lowest price in the market, and being able to provide that to our customers, and then great customer service. We've got our inventory is up 35% on a 3-year basis. We'd love for it to even be up more. Our customer service is running at all-time highs. We've nearly doubled our team member headcount over the last 3 years. And the same thing on pricing. We move 8 billion pounds of food and feed on an annual basis. And so that scale allows us to be low cost to serve in the market and hold down the inflationary pressures as much as possible for our customers. And I'd say those are some of the big key differentiators we've had. And the big thing as it relates to digital is really bringing an end-to-end customer experience to our customers, leveraging everything from our mobile app and the scale to in-store technology to just bring that seamless experience that our customers expect from these national retailers that they also shop at, but haven't historically gotten in a farm and ranch channel.
Hal, one of the things that we talked about after your vendor event that you were kind enough to invite me to was, and I don't know if you remember saying this, and I thought it was particularly interesting since you've worked at places like Home Depot and Macy's, which are very large format stores, is you said that the small size or the smaller size of your stores was a key competitive advantage. And I think that kind of fights against the general narrative that bigger is better in retail. Could you just describe what you meant by that a little bit and why you think it's so important?
I always comment on two things in the history of the company. I think first, the most important decision that was made by predecessors in the company was really around our culture and creating a firm foundation grounded in our mission and values and the notion of servant leadership inside the company. And more than anything, our culture has been the foundation for our success over the last 84 years and will certainly be the foundation for our future as well. All that said, if you look tactically at the business model, as you and I were discussing, Steve, I think one of the best decisions are the founders, the modern day founders of the business made was the size of our store. And I think, in retail, if you think about the other ends of the spectrum on this large size spectrum, think about the countless number of retailers that wish their stores were smaller, and they struggle to maintain inventory turns and vibrancy of their inventory in the store. They're struggling to find enough programs to substantiate the square footage. They're deleveraging on headcount and the ability to provide adequate customer service. And there's some retailers that are doing great with these big box 100,000 square foot stores, but there's a lot that wish they were substantially smaller. And there's been a bit of a relief over the last couple of years from that type of perspective in the market, just given everything else that's been going on. But retail will certainly snap back to previous trends, and I think we will again revert back to the dialogue around retailers having too much square footage and their stores being too big. On the other hand, I think you can also be too small. And, when stores are 2,000, 3,000, 4,000 or 5,000 square feet in size, you struggle to get leverage. And that's one of the advantages a big box has, is you can leverage this cost of your square footage as you grow sales and to achieve higher margins. And, the problem with, say, a small square footage store, not to call anyone out, but say take the notion of a typical Ace Hardware or something of that size, is that you can't really scale on it, either on the sales per square foot. Eventually on a sales per square foot, you kind of top out, but certainly on the leveraging you have on your fixed costs. And so, when you kind of take both ends of the spectrum and kind of come to the middle, this 15 to 20,000 square foot format that we play in really allows us to scale to $400, $500, $600 per square foot and get really good sales productivity and space productivity. But at the same time, being that we're in rural America and typically lower retail costs in general, real estate costs in general, we're able to really scale on that. And then in 15 to 20,000 square feet, you can provide good customer service still, particularly with a racetrack format. We can put people in each one of the four corners. We've got our customer service hub in the middle. And so we're able to provide, best-in-class customer service in combination with a, business model that provides for sufficient scale and fixed cost leverage. So anyway, I think it's really the kind of the perfect size format for us to be. And we one of those things we're very fortunate for that to be the case now, 2,150 stores into our format.
So 2,150 stores, I imagine growth looks something like getting perhaps more suburban, ex-urban, the blend. Is that blend going to change? And is that going to affect how you merchandise or how you think about size or location? Is any of that on your mind right now?
We see our future store potential to be 2,800 stores in the United States. The profile of those stores won't change much from the ones we have now, which is almost all ex-urban or rural. I sometimes will comment that we don't have a store within an hour's drive in New York City, but we have two in Odessa, Texas. And, that's just indicative of the type of customer we serve and the geographies that we play in to serve those customers. The one thing I would say, what's evolving in our business is the type of customer that's shopping us. Our unaided brand awareness pre-COVID was in the high 30s. And our unaided brand awareness post-COVID now is in the low 60s.
Wow,
and so
that's a big jump.
We've made significant investments, namely in video marketing, both television as well as digital, to drive our brand awareness. And as a consequence of that, not only has our core customer continued to shop us through COVID, and also we've gained share just because of our in-stock and our pricing and our customer service in the midst of COVID, but we've also captured a new customer. As I mentioned earlier, the notion of rural revitalization, and you've had a lot of, the U.S. population that's moved, 30, 50 miles further out from where they were living prior to COVID. And as those customers moved out, they've been dominantly the millennial generation. They've over-indexed to the millennial generation. They're starting to embrace those typical generational norms that millennials maybe had been putting off for 2 or 3 more years than the historical kind of generational norm curve. And as they move out, they want to embrace the lifestyle, right? They want to get animals, they want to get pets, they want to still live that kind of organic, sustainable lifestyle. And so, whether it's planting fruits and vegetables, having gardens, they want to still live that same kind of that same responsible lifestyle even as they move out, and they want to take advantage of the space and begin that kind of next set of, whether it's getting married, buying a house, having children, whatever the case may be. That the millennials are now embracing those generational norms, and that's really benefited us. And I'd say is the biggest trend change in kind of the profile of our business over the last few years.
You joined Tractor from Macy's, a retailer that I think we could probably agree has had some challenges in terms of getting back onto any kind of profitable growth trajectory. Not looking so much for a critique of Macy's, but I'm curious, given the different places you've been in retail and now all the success that Tractor Supply has been having, Are there any general kind of leadership lessons that you could share with our audience that speaks to strategy or execution or culture or all the above?
In my 20 plus years now in retail, and Steve, you talk about this quite a bit in your writings and other activities, it's all about staying ahead of the customer. I think businesses that evolve and invest to stay ahead of the customer, retailers continue to be successful to today, no matter if they're a 5-year-old retailer or, like us, an 84-year-old retailer. Retailers that don't invest in their stores, don't invest in their teams, cut expenses to hit, a particular quarter's numbers, but do it at the expense of, long-term brand viability are the ones over time that struggle. And if you were to look at the list is long of retailers who have gone out of business. And, I think the one thing that's in common is either they've not invested in their stores, and so the experience in the stores became unacceptable, or they began to cut labor, and so then they lost customer service, and you had a downward spiral there, or they didn't evolve their business model to reflect evolving customers' needs, whether that's in the portfolio that they carried in the store, whether it's the ability to embrace things like omni-channel, or whatever the nuance is. I mean, I think about in our history, 40 years ago, we didn't sell animal feed in a big way, and now we're far and away the largest seller of bagged animal feed in the country. Somewhere between a 20 and a 25% market share, depending on the animal. Same thing, 20 years ago, we didn't really sell pet food in a destination-like way, and now we're a top 5 pet food retailer and definitely the biggest share winner over the last 3 years in the midst of COVID. And now we're evolving our business again to build garden centers and get into the live goods business as a destination. And I think that's the key thing is we're also investing in our stores right now too. 2019, we invested $275 million in our business. This year, we'll invest $700 million in our business, so almost 2.5 times. And, the large driver of that increase has been investment in our stores through our Fusion remodel program with the goal of remodeling all 2,000 plus of our stores over 6 years. So it's about evolving and staying ahead of the customer, adjusting your marketing, adjusting your assortment, making sure your in-store experience stays best in class. And I think if you do that in retail, you can continue to serve your customers for a long period of time. But if you don't, they can always choose to shop somewhere else. You've got to earn their business every single day.
So, Hal, very impressive story. I mean, tremendous growth. You've already got some roadmaps into where you're growing that you've articulated. But what's next for Tractor? I mean, how do you sustain that kind of the growth you've already again articulated? The growth into gardening and acquisition. Could we expect more of that? Give us the broader lens on the strategy for growth beyond the already impressive store count and different things like that.
Yeah, we've got, as I said earlier, incredibly bright past. Over the last 84 years, we've had 31 consecutive years of positive revenue growth. That's through the recession of 2000 and the Great Recession around 2008 and 2009. Certainly the COVID recession now. But we think we've got an equally bright future. And we're investing heavily in our store remodels, which are giving strong lift. We're investing heavily in our Neighbors Club program, which is our loyalty CRM program. We're investing heavily in digital and in our supply chain to make sure we stay ahead of our evolving customers' needs. And we think the best times are still ahead for Tractor Supply. And we think with the new store count growth we've got, with our existing store sales growth that we plan on having, billions and billions of dollars of sales growth ahead of us. And we put all that under the umbrella of what we call our Life Out Here strategy. It's got a 5-year runway ahead. It goes out to 2026, 2027, and a very defined amount of investments. And as you can imagine, given our market, our total addressable market's $180 billion, and our revenues this year will be 40. So we still have under a 10% market share. So a long runway to execute on our Life Out Here strategy, but also, as you can imagine, a lot of other items on the list for down the road after that too. I think the possibilities are limitless for us in terms of continued growth.
Well, fantastic. I mean, you've got amazing momentum. You've got a clear eye in terms of the strategy fixed on everything that you anchor it back to, this focus on stores, this integration of e-commerce. Listen, it sounds fantastic, and really appreciate you sharing both your journey and more about Tractor Supply. It's an impressive organization, clearly, and it's great that I get to and the listeners get to learn a whole lot more, and something that we can pay attention to and probably you definitely learn a lot from. So listen, thanks again for joining us on the Remarkable Retail Podcast. It's a real treat to hear from you, and thanks so much. You're clearly a busy fella, so thanks for taking the time out to chat with us, and we wish you continued success and a great rest of your day.
Well, thank you so much. Again, I appreciate you all having me on. It's been a pleasure to talk with you the last half hour.
If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platform, so you can catch up with all our great interviews, like our discussion with Seth Godin on what retailers can actually do to fight climate change. New episodes of Season 5, presented by Marketal, will show up each and every week. And be sure and tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, and producer and host of a series of retail trade podcasts, including this one, plus the host of the popular YouTube cooking show Last Request Barbecue. You can learn even more about me on LinkedIn or meleblanc.co. Safe travels, everyone.